Good afternoon, everybody. Uneducated Economist here. So, thought I would talk a little bit about this. Oops, let me put my little algorithm hating logos little strap on there. Make sure that no algorithms will block my videos. At least not from the images they see, anyhow. Maybe from some of the words we use or the titles we put on the videos. But today I wanted to talk a little bit about this statement coming from Jerome Powell talking about the United States being on an unsustainable debt path. Now, this is not new. This is something that they have been talking about for quite some time. And a lot of times when we hear them reiterate this, everybody says, oh no, they start freaking out and start, thinking that the Federal Reserve is losing control or that, the whole world is about ready to collapse. This is not necessarily the case. The Federal Reserve was well aware of the situation that they were putting the United States in, like the government in, right? The more that they were trying to create a situation in which that the ability to stimulate, right, through fiscal policy was achieved through the central bank's ability to print money and buy treasuries. So when the government went into a bunch of fiscal stimulus where they are going to go into debt, borrow money, put it out there to do infrastructure projects, to hand out for, for like entitlements, all this stuff, right? Well, the more that the United States issues this debt, the more of a problem that it's going to be like on this debt path. Like we're continually going deeper and deeper into debt, and everybody is now saying, hey, this is a major problem, including the Federal Reserve saying you can't continue to do this. Okay? But my question is what is it that the United States is going to do? Like they got to come up with the money somehow. Now you can either cut government, likely that's going to happen. You can charge more in taxes, right? Because that's always goes over well. Or you can issue out more debt. Now, issuing out more debt is the problem that the United States is now facing, and what the Federal Reserve is saying, you can't continue to do this. You will fail. Like right now, there is still a chance that it's not unsustainable. Like we can take care of this debt. I doubt that personally, but from their own imaginations and their own ideas, the Federal Reserve is saying, no, this is not unsustainable where we're at. What we're doing is going to continue down this road, which will be unsustainable. We can't continue to do this. Now, that leads me to believe, what is it the Federal Reserve is going to do? Like, if they don't print the money, then they're just going to sit there and watch the whole thing begin to collapse? That doesn't sound right. The Federal Reserve needs ways to inject money into the system, and typically it's done through that treasury market. Now, when the Federal Reserve was first created, they said, no, we'll never go buy these treasuries. Not like that. That's monetizing the debt. That would essentially be illegal. We can't do that. Well, that's what they're doing now. Right? See, the Fed doesn't go directly to the Treasury and buy the Treasury debt. They go to the primary dealers. So everything the Federal Reserve is buying is something that has already been purchased. They're just simply going out there to the primary dealers after auction and buying the treasuries for them. Well, if you're a primary dealer like the big banks, well, you got the Fed backing you. You're probably just going to be as willing to buy as many treasuries as you want, knowing that the Federal Reserve is going to step right up there and buy them. But if it comes to a point where the Fed says, no, we're not going to be buying those treasuries anymore, right? We can't do this because we're forcing the government, the United States, into an unsustainable debt path. These guys are independent. Right? Now, this is going to be a moment in which that, like, say, Donald Trump might step up and say, hey, we need to take this independence away from the Fed because they're in a situation that's going to force the United States into an unsustainable debt path. But this is what the Fed is warning the United States about doing. So if they don't go on this unsustainable debt path, we're going to start facing some economic pain, whether it comes from government cutting, higher taxes, but whatever comes from it, it's not going to be a pleasant, better standard of living. It's going to be a diminishing of our living, whether it's cut from government or cut from our paychecks. Okay? That's ultimately what the path is going to end up being if we continue down that. Now, what I found very interesting is that this is not a concept that is like coming to a surprise to the Federal Reserve. They're like, hey, man, we need to figure out what we need to do about the unsustainable debt path that you guys are on. It's not like this is a new thing. They've been talking about it for a very long time. And in fact, if we take it all the way back to a Ben Bernanke speech where he was talking about deflation and how to prevent it from ever occurring here in the United States, he mentions that the Fed, that the Treasury and the government is on an unsustainable debt path, and that the Fed cannot be the purchaser of all this debt, driving them ever deeper into debt to try and provide the money, trying to get the liquidity out there to the world. So as the world is demanding dollars from all the debt that has been issued out in dollars, the Federal Reserve has to figure out some way to provide the world with those liabilities. And right now, it forces the United States government to go deeper into debt, which is unsustainable, giving the Federal Reserve pretty much a position in which that their hands are tied. It was like, how do we get the money out there to the people, out to the globe, out there to the world, and not force the United States into bankruptcy by having their debt issuance being our basic only asset that we purchase? Talking about the Federal Reserve. They knew this. They knew this to be the problem. I mean, I hope people understand what's going on here, because it's a lot deeper and harder to wrap your head around as something as simply, oh no, the government has all the money they want. It doesn't work like that, right? The government has debt issuance, and the Federal Reserve prints up liabilities to buy that debt. And what the Federal Reserve is saying is that we are not going to print up these liabilities to continue to buy this debt. You are going to force yourself into an unsustainable debt path, and it's going to crash you. Now, Ben Bernanke goes on to say this. In this speech from 22 years ago. Now, here it goes. The Fed can inject money into the economy and still, well, let me back it up just a little bit further here. Let me read to this one. I suspect that operating on rates on long-term treasuries would provide sufficient leverage for the Fed to achieve its goals in the most plausible scenario. If lowering yields on long-dated treasury securities proved insufficient to restart spending, however, the Fed might next consider attempting to influence directly in the yields on privately issued securities, and directly in the yields on those. Unlike some central banks, and barring changes to current law, the Fed is relatively restricted in its ability to buy private securities. Private securities are corporate bonds. Okay. However, the Fed does have broad powers to lend to the private sector indirectly via banks through the discount window. Therefore, a second policy option complementary to the operating in markets for treasury and agency debt would be for the Fed to offer fixed-term loans to banks at low to zero interest rates with a wide range of private assets, including, among others, corporate bonds, commercial paper, bank loans, and mortgages deemed eligible for collateral. Right? This is the beginnings of quantitative easing. This is the very beginnings of it, trying to figure out how it is that they can inject money into the system, considering that their hands were very limited on what it is that they can lend money towards. They do not have the authority to lend to corporations. However, they could lend to a bank who does lend to the corporations, right? So they could go through this kind of roundabout way of getting it to them. Commercial paper, bank loans, mortgage, okay, deemed eligible for collateral. For example, the Fed might make 90 to 180 day zero interest loans to banks, taking corporate commercial paper of the same maturity as collateral. Pursued aggressively, such a program could significantly reduce liquidity and term premiums on the assets used as collateral. Reductions in these premiums would lower the cost of capital both to the banks and the non-bank private sector over and above the beneficial effect already conferred by the lower interest rates on the government securities. Very complicated to understand. Ultimately, what he was describing there was the beginnings of quantitative easing. Before it was, this is again 2002, quantitative easing didn't take place until after the great financial crisis, literally 6-7 years later. Now, understanding what the next part is understanding that the quantitative easing part of it is now failing. Like in their plan, they know that quantitative easing and the lowering of interest rates and hitting the lower bound of zero and all that other stuff will work for a short time. They can't use that tool forever. There's going to have to be other ways of going about this, injecting money into the system, right? See, like the quantitative easing forced the United States government into an incredible amount of debt. They had to issue the debt to create the treasury for the Fed to buy, okay? And that's like the scariest part about all this, is that the Federal Reserve is saying, you guys can't continue to do this, but we, the Federal Reserve, need to figure out something to buy, because you guys are on an unsustainable debt path. Here he goes. The Fed can inject money into the economy in still other ways, right? If the quantitative easing is failing, right, we got to figure out another way. And this is where the Fed has talked about it. Go hit that like button. We got 6 likes with 246 people watching. Go hit that like button. The algorithm will pick up the video and spread it around for more people to join in. The Fed can inject money into the economy in still other ways. For example, the Fed has the authority to buy foreign government debt. This is what Ben Bernanke was saying. After the quantitative easing has failed and all that money printing and forcing the government into unsustainable debt paths, we're going to have to figure out some other way to inject money into the system. What is it? Still other ways. For example, the Fed has the authority. They don't have to look for the authority. They already have it. Has the authority to buy government debt as well as domestic government debt. So they buy the domestic, but they really don't buy the foreign. They could, potentially. This class of asset offers a huge scope for the Fed's operations. And the quantity of foreign assets eligible for purchase by the Fed is several times the stock of U.S. government debt. Now, granted, this was given during a time in which that the debt was much lower and there was less debt for the Fed to purchase, and it's obviously much more now today. But what he is talking about is that there is an insane amount of debt out there that the Federal Reserve could buy that is outside of the United States. They're talking about buying the debt of foreign nations. Now, think about that for just a second. The Federal Reserve puts foreign bonds, not United States Treasury bonds, but foreign bonds, goes and purchases those with United States Federal Reserve notes, U.S. dollars. Now, U.S. dollars have a backing on them of foreign debt. This is insane to think about. I don't know how many people have internalized this idea that this could be a possibility coming to the future. This speech, I left a link down in the description, describes what it was that the Federal Reserve was going to do when they ran into the lower bound of zero. They knew interest rates were going to hit zero, and that stimulating the economy with the lowering of interest rates wasn't going to work. He describes quantitative easing perfectly here, and he says when that runs out and it doesn't work anymore, what are they going to do? They're going to step into the purchasing of foreign debt, because that menu is huge comparatively to what is offered here in the United States. He goes on, I need to tread carefully here, because the economy is complex and interconnected system. Fed purchases of the liabilities of foreign governments have the potential to affect a number of financial markets, including the market of foreign exchange. In the United States, the Department of Treasury, not the Federal Reserve, is the lead agency for making international economic policy, including policy towards the dollar. And the Secretary of Treasury has expressed the view that determination of the value of the U.S. dollar should be left to the free market forces. Moreover, since the United States is a large, relatively closed economy, manipulating the exchange value of the dollar would not be a particularly desirable way to fight domestic deflation, particularly given the range of other options available. Thus, I want to be absolutely clear that I am today neither forecasting nor recommending any attempt by the U.S. policymakers to target international value of the dollar. All right? He was like, no, I'm not saying we should do this. I'm just saying that it's a possibility that we do that out there. And it's really the Treasury's Department to figure out what the value of all this is, and not the Federal Reserve. But if there was coming a time in which that quantitative easing through the purchasing of U.S. debt was no longer an effective tool, what are they going to do? Right? They have this option of buying it. Although they say that they're not forecasting, nor do they want it. They didn't forecast quantitative easing. They said that they were doing everything they could to prevent the deflationary scenario. And that if all else fails and they can't stop it, quantitative easing was their option. We are doing it. They ran out of options. It didn't work. They couldn't prevent the deflationary scenario. The problem that they were facing way back in 2018, if you read this speech, Monetary Policy for a Low Neutral Interest Rate World, you would find that its inflation expectation was persistently too low rather than too high, and that was interfering with their monetary policy. Can you see what's happening here? Like here, let me say it simply. The Fed needs to figure out a way to inject money into the system, and the way that they were doing that was by buying U.S. government debt, and they're saying they can't do it anymore. That if they continue to do this, the U.S. will crash and burn. Right? So going back to this speech, after you did all the things that you could do to prevent the deflationary scenario, and you finally go into quantitative easing, and you do mass printing of money, and you're buying up the government debt, and that no longer works anymore, what is it that Ben Bernanke said that they could do? Buy foreign government debt. That's what he said that they could do. All right. Although the policy of intervening to affect the exchange value of the dollar is nowhere on the horizon today, right? This was 22 years ago, right? It's on the horizon now. It's worth noting that there have been times when the exchange rate policy has been an effective weapon against deflation. A striking example from the U.S. history is Franklin Roosevelt's 40% devaluation of the dollar against gold in 1933 to 34. Enforced by a program of gold purchases and domestic money creation, the devaluation and the rapid increase in money supply it permitted ended the U.S. deflation remarkably quick. Indeed, consumer price inflation in the United States year on year went from negative 10.3% in 1932 to negative 0.51% in 1933 to a 3.4% in 1934. The economy grew strongly, and by the way, 1934 was one of the best years of the century for the stock market. If nothing else, this episode illustrates that monetary actions can have powerful effects on the economy, even when the nominal interest rates is at near zero, as was the case in the time of Roosevelt's devaluation. So you can't tell me they don't have a plan. Everybody says that they're flying off the seat of their pants, flying off the seat of their pants like they don't know what they're doing. That is completely inaccurate. The Federal Reserve is well orchestrating this, including the inflation expectation, which was a desired outcome coming from the Federal Reserve. They needed it, right? It says right here, today we face an altogether different set of problems stemming from a very low neutral interest rate. The neutral interest rate is the rate that is neither accommodating nor restricting the economy. When the Fed is neutral, that is where everybody is looking at it saying this is where we want to be, right? If they want to stimulate the economy because of a slowdown or financial markets are freezing up, lowering interest rates is what stimulates the economy. That neutral interest rate was so close to zero that when they lowered it below the neutral interest rate, they hit zero and it couldn't stimulate the economy. Their game was done. They knew it. They knew that game was going to be done from way back 20 years ago when Ben Bernanke was talking about it. They said, yeah, that's going to screw up monetary policy and lowering interest rates won't be an effective tool. They knew this, but that's okay. We got other ways of dealing with this. And part of that is the credible threat theory, which he explains within this speech itself. And it goes on to say, right, because of this low neutral interest rate, that is the short-term real interest rate consistent with an economy operating at its potential alongside low and stable inflation. Ironically, the problem we need to solve these days is the risk of inflation that is persistently too low rather than too high. bang, right? All this stuff is exactly in line with what the Federal Reserve is looking for. And this warning, this critical warning that the government is on an unsustainable debt path is something that they knew about 20 years ago. And they said, once you achieve that level that you can't go down any further, we're going to have to switch over on the menu of stuff that we buy. And you guys aren't it. Not the treasuries. It's some other foreign nation out there, and they're going to print up dollars to buy that foreign nation's debt. This just to me screams like New World Order takeover of the entire currency system. And it seems to me that it is very well orchestrated from many years ago. And now when you think about the idea that they are trying to regulate stable coins right now, stable coins being backed by dollars. Like if you have a cryptocurrency out there that was backed by a dollar, basically it's these stable coins, right? So now stable coins have cash and short-term treasuries, things that are very close to cash backing these things. People are going to start using these stable coins. The Federal Reserve is screaming that these things should be regulated. You get people start to use those stable coins that are being backed by dollars. The Federal Reserve can adjust their monetary policy, and that monetary policy will flow right through the dollars and into those stable coins. So long as those stable coins are backed by dollars, it doesn't matter what it is that people are assuming is going to be taking place with monetary policy. If they are backed by dollars, anything that the Federal Reserve does will transfer right into those stable coins. Same thing happens to a foreign nation. If they back their dollars 1-to-1 or their currency by dollars and they say, hey, we are going to lock it in 1-to-1 with the dollar, any monetary policy that takes place within the United States transfers right into that foreign nation's policy. And now this is something very critical to understand, because if the stable coins really start to become prevalent within the economy, they can pull cash out of the system. Everybody starts using stable coins. We grow accustomed to using stable coins, and then one day we find out that those stable coins are being backed by foreign debt. And we didn't even realize that took place. And to think that it's not in the plans, it's right here, right? You just have to start piecing it together. He said it, that the menu of assets that the Federal Reserve could purchase is absolutely gigantic, immense outside of the United States. How do they do that? How do they inject this money into the system without and not lose control over it? You think about it, the regulation of stable coins can then dictate where this money goes, if it leaves that nation, what it can buy, who can be done business with. All the nightmarish stuff that comes from a digital currency can then be brought to fruition through the stable coins, through the efforts of the Federal Reserve, and this is something that they are planning. Right? Like this isn't like they're not sitting around going like, how do you think we can do this? You know? Like, how do you think we can figure this all stuff out? They've done figured it out. Like, they know what they are doing. They are planning this. But they can't explain that to you. They're not going to come right out and say it. You have to piece this stuff together through speeches and documents and statements that they have been making for years. Right? And you can't let any of it go. Like a lot of people say, oh no, man, that was from 5 years ago. None of that stuff matters anymore. Absolutely it matters. Their game plan is far longer than just 5 years. Longer than a decade. Right? This is good. They have lifetime plans going here. All right, man, I've been really going off 23 minutes. What time is it here? Alrighty, guys, I got about 5-10 minutes and then I got to jet out. A shorter live stream for you. Oh, geez, I'm choking on my water. Excuse me. So we're not going back to a gold back money. No way. Never in a million years, savagely, will we go back to a gold back currency unless we see an absolute, utter, complete collapse of the entire system. Because going back to a gold currency would mean that we would fall into misery and poverty pretty much immediately. Foreign imports would essentially halt. We don't manufacture enough to really support ourselves, and the poverty and misery that would come from it would be so impactful that nobody would be voting for politicians who would be voting that way, who would be leading us that way. So no, the gold standard is an absolute, like absolute no way. Like that is not an option unless there's a complete collapse. Now, however, on the flip side of that, I believe that individuals, like us as an individual person, should absolutely hold as much gold and silver as we can get our hands on, to stack it as much as you can. And it's not so much as you can to like overwhelm like what it is that you have. Like don't be 100, like in my personal opinion, don't be 100% in gold and silver, but definitely have a significant position. Some people say like 5%. I think like 20% would be better for an insurance policy kind of attitude. It's not financial advice. That's just kind of like my personal opinion. Anyone see that $1 million token started by Tech Lead? Nope. Let's go check out the super chat. Ham Sandwich, I love the name. Ham Sandwich P, $4.99. Thank you so much for the super chat. What does it say here? How fast will the dollar become worthless if they start bailing out other countries? That's the thing. I don't think the dollar will ever become. I don't think the dollar can become worthless so long as you have debt issuance outside of the United States that is being issued in dollars. Like this is the reason, like one of the greatest, not one of the greatest, a really good paper coming from the Federal Reserve is dollar funding stresses in China. Read that, dollar funding stresses in China. I think it came out about a year ago or so, maybe 2 years ago. If you read through that document, and it's kind of long, take into consideration that the things that they are talking about that are occurring in China are occurring throughout many nations around the world. And that is that the debt issuance that has taken place, like people literally writing contracts to each other, right? They don't have anything to do with the United States, but they're done in dollars. That creates a demand for dollars unlike any other nation is experiencing, right? And that is really where the demand for dollars comes from outside of the United States, is people need to get a hold of those dollars in order to fulfill those contracts. And this is where like the Fed is being forced to like essentially create this liquidity out there, and they don't really have any way of doing it without buying the US Treasury debt. Like they can buy mortgage-backed securities and stuff like that, but that keeps driving the houses prices up, and that's an, again, unsustainable debt path, right? Same thing with the US Treasury, same thing with everything. So they're like, well, we can either fail or we can figure out a way to continue on creating this liquidity out there, and it'll be through the purchasing of foreign debt. So like how fast will the dollar become worthless? I don't think it'll become worthless. Like I think the demand for dollars outside of the United States, regardless of how much they print, is still so dramatically high that it just continues to create this demand for dollars that doesn't allow it to lose strength. That's the problem with it, is there's nothing else out there that can compete against the dollar for that position, right? Like if people were writing each other contracts that were due in yen or yuan or rupees or rubles or something like that, and they do write those contracts, the problem is that they're so insignificant, the amount of them, that they're not going to be able to facilitate the world's transactions. See, people write these contracts up in dollars so that they can do trade with each other. But you write these contracts up in rupees and all of a sudden the trade starts to slow down because nobody really wants rupees. They all want dollars, everybody. And there's nothing else out there that they can say, hey man, I don't like the dollar, let's do something else. They're like, yeah, that's a great idea. What? Nothing. There's nothing there. You go ahead, use rupees, use euros, use something else. Nobody really wants all that stuff. Maybe euros on a much lesser scale. Okay? Everything is done in dollars, and that's it. And until there's a replacement, which can't necessarily come up and say, hey, I'm a competition to you, right? They can't be a competing currency. Gresham's law already says that if there's bad money in the system, that's going to force the good currency out. People will hoard the good currency. And there can't be a rise of a bad currency because nobody would use it. So the only way that a currency can take over as a world reserve currency is to form a symbiotic relationship with the current world currency, very much like dollars did with gold. People thought that dollars were as good as gold. I mean, even Bernanke was talking about it back then. The devaluing of that gold, or the devaluing of the dollar to the gold, is what flipped everybody out back then. All right, they watched it go from 20 to 36 or whatever it was, 32, or I forget what the exact number was. That right there, that was like the ability of the government and the Fed and everybody else to all of a sudden provide the liquidity that everybody was looking for, right? And that's exactly what the Federal Reserve was talking about. All of a sudden, boom, here's all this money that you can now have. I mean, even how did he describe it? Let's look. What did he say back then? I don't know how much time do I have. I probably don't have enough. I do. I got a few minutes here. Okay. Right here, right? The exchange value of the dollar is nowhere on the horizon today. It is worth noting that there have been times when the exchange rate and policy have been an effective weapon against deflation. A striking example was the U.S. history in Franklin Roosevelt 40% devaluation of the dollar against gold in 1933, right? See, they needed to figure out a way to get the liquidity out there. They need to get the money out there. How, right? Well, to devalue gold, and therefore we can have all this gold and we have all this money. Let's print out the money to, after we revalue it to gold. But now this time around, they're like, man, we got to figure out how to get the money. How do we get the money, right? How do we get the money out there to the world? Well, we got to continue to buy U.S. debt. We can't. U.S. debt is on an unsustainable debt path. We can't buy that stuff. What do we buy? And again, this is like, Ben Bernanke was saying, we shouldn't do this, but we could, right? Who in their right mind is lending money to the U.S. government that's 35 trillion in debt, increasing by 2 trillion per year? An insane amount of people. You know how many people have U.S. Treasury? You know how many people were talking and bragging and screaming about how awesome the money market and their savings and the short-term treasuries are paying them? That's individual people lending money to the United States government. Insurance companies, corporations, individuals, countries out there. Everybody in the world needs a safe and liquid asset to trade with each other. It's the U.S. treasuries. There's nothing else. People talk about how the U.S. treasuries are some worthless garbage thing. That's not true. People who say that are just making stuff up. Right? You go around the world, there is one safe and liquid asset that everybody is wanting, and that's U.S. treasuries. Right? Everybody would love to have gold. Gold is cumbersome. It costs money to ship, it costs money to store, it costs money to secure, it costs money in every single way. U.S. treasuries, easy to sell. Boom, instantaneous liquidation. Right? Everybody's accepting of it. In fact, they're so accepting of it that they use U.S. treasuries to facilitate the trade instead of cash, because at least when you're holding U.S. treasuries, you get a little bit of return off of it. Cash, again, is burdensome. It costs money to store, it costs money to transfer it. Yeah? And this is we have to understand this. There is a global slowdown in activity happening. There is less need for a lot of the transactions that were happening just a few years ago. And if that is the case, then people are losing out on the ability to acquire cash. Right? If there's less transactions, you're not doing business, you're not acquiring cash. And if you're not acquiring cash, you're having troubles making your debt payments, because your debt payments are due in cash. So if you have trouble doing business because you can't do transactions, you're not selling stuff or not selling nearly as much, or you're having to discount it to get that cash, and there's not enough cash to pay your debts, what are you going to do? You're going to start selling off the assets that do get you into cash. And what is the number one asset that will get you into cash? Treasuries. So people are liquidating U.S. treasuries to get the cash, because the cash is what they need to pay their debts. And that's the problem that most people are experiencing today. But yet most of the news articles out there are saying, yeah, dollar's done, dollar's cooked, everybody hates dollars, look at them dump the U.S. treasuries, pure evidence of it. It's not the case. They're telling the story wrong. They're giving it incorrect meaning. Right? And that's an unfortunate consequence of misunderstanding what is truly happening within the economy. Right? Go hit that like button, everybody. We only have 30 likes. Nobody liked the video? Nobody likes my videos? Gosh. Yeah. All right, guys. We are ending it. We have to end it right here. This is it. Thank you for helping others by spreading this knowledge. Is there any advice you would have for someone who is going to start reading Cantillon's theory? Read the entire book, but I think it's the 3 chapters on the increase in decrease of money to the state that are by far the most important chapters within that essay. All of it is really good, right? But those 3 chapters are just incredibly powerful. Why are the auctions not selling out? I don't understand. I mean, is there a failed auction? I don't think that, like, I mean, I understand that prices will fall, yields will begin to rise, but I don't think there's ever been a completely failed auction, right? Did you know when you deposit money in the bank, you become a creditor to the bank, i.e. it is not your money? 400 people watching with only 32 likes. Come on, people, hit the like button. Yes, really, truly, man. I mean, we didn't get any likes on this. This is sad. Alrighty, guys. I appreciate you all being here. Thank you very much for those who did hit the like button. Thank you very much for the $4.99 super chat. I really appreciate that. Supporting the Uneducated Economist. Left links down in the description. I think that's it. All right. Uneducated Economist. You guys let me know.